Hi there, Billy Peterson. I am here today to go over some of the issues that we're seeing across the media outlets and with the concerns that we're seeing from the Federal Reserve to inflationary factors to the war in Ukraine and all these events that are making us get a little bit more emotional in how we're handling our investments. So I'm going to talk for a minute about that, and then Shaun's going to talk a little bit about how we recommend investors navigate this and do it on a right down to the basic level. So let's talk about this inverted yield curve first. We want to share with you where things are. So I'm going to write down on the board where all these yields are. And we're talking about government bonds right now. I believe the 30-year is, last I looked, was 2.74. And the 10 years are at around 2.63, and then that leaves the 2-year at about 2.5. So we see I have a normal sloping yield curve, and that looks like this. If we have the time on this axis and the yield on this one, we're seeing this kind of sloping upward, because the longer you go out on the spectrum, the more yield you expect to receive. Now what happened last week is these two numbers inverted. So it took this yield like this, so the slope inverted. And what you see a lot of people say in this type of situation is a recession is on the horizon, because I've done some backdated testing and saw that whenever you see an inversion like this, a recession is going to happen. Now it's funny to predict it that way because there's such a wide disparity on when that might occur or might not occur. It's not a perfect prediction. Many times this has happened and there's been no recession for a long time. But what they've done is boiled it down into about a 3-year window. So anywhere from 1 year to 3 years from now or from last week, we could expect a recession. So I'm not telling you that this is for sure going to happen or when it's going to happen. We do know there are concerns. We also know that recessions don't mean we should just run for the hills or dump all of our stocks, put all of our money into a suitcase. That's never the right strategy. Recessions are just a scary word that the media loves to throw in our face because it makes everyone nervous. And why do they want to make us nervous? It's because they want us to tune in, watch what they're saying, get scared, think we need to do something, because that's when the advertisers will pay for advertisement, because they're going to get your eyeballs. So we're not too worried about that. We're just saying that a recession is likely sometime. There's been 13 of them, by the way, in the last 60 years. So it's not that we're overly concerned. And we anticipate another one, maybe next year, maybe the year after, sure, maybe this year. I don't know. We do know that the Federal Reserve is going to have to raise rates a number of times. We're starting at a very low level on interest rates. Inflation's running at close to double digits now, if not more so. A lot of the consumer items that you and I purchase regularly to live have increased by more than 10%. You know, the way they measure inflation is different, and it's giving everybody concern right now, of course, just to manage their day-to-day living expenses. It's not going to stop. This is something that we've been talking about for quite some time. It's going to continue with us for a while. But the normal yield spread between these two rates, the 2 and the 10, is anywhere from 1 to 1.25%. And you can see how that's tightened right now. And that's because what the market is expecting to happen is a slowdown in economic growth. And that's the word we're concerned with. And you haven't heard about this a lot yet, but you're probably going to soon. That's called stagflation. That's when you have inflation and a stagnating economy at the same time. And that's the worst of all worlds, because everything's costing you more, but the economic growth is going down. You're seeing job losses, you're seeing lower wage growth, you're seeing increase in mortgage rates and everything like that. So you could see a complete reversal in all this uptrend in real estate values. The hot housing market's going to certainly slow down. What we want to talk about is, what do you do now? And where should you be putting your money, and how do you navigate this environment? Remember, we talked about bonds, and this is the normal kind of environment when we're dealing with bonds. When you have your yield or your rate and then your price, is when we're dealing with bonds, we're usually talking about individual bonds. Most of our clients own bonds through mutual funds, so it's not that we own, we're looking at the price on an individual bond typically. Now, this is just to represent the overall market in bonds, but the yield is such that it offsets the price, vice versa. It's a teeter-totter. So if we looked at let's say a 3% yield out here, and the price was $1,000 for that bond, and things were kind of at equilibrium right there, close. We have one a little bit lower than the other. But then we see an increase in rates. And let's say they just jump by 1%. And this is really the factor that most people need to understand. Rates are going higher. There's no holding that back. They have to. Just based on the law of monetary policy right now with the Federal Reserve trying to slow the economy to pull back runaway inflation. That's going to send the price of this bond down. And let's just say, I'm just using kind of general numbers here, but a 1% increase in rates on the long end will typically show about a 10% decline in a bond. And that might be just the start of this problem. So that's why we've been talking about the risk associated with bonds and bondholders. And that's why we've significantly reduced our exposure and reduced the duration. So instead of going all the way out to the long end of the yield to try to buy long dated bonds, we're buying short ones that are going to come due, so then we can reinvest at hopefully rates that are higher rather than having to wait a long time to get our money back. So inflation, we talked about inflation being, I think, the number one buzzword. I think this is going to be the word all politicians are using going into these midterm elections. And this is just the reported number. I think the actual number is even higher than this. All the people that we deal with, from the basic level farmers, crop growers, people that are dealing with the raw materials, we're seeing much higher, probably double that, so closer to 15 or 20% raw material increases. And that's still being pushed through to the consumer. So you're going to see higher numbers going forward. Let's talk about comparisons though. When we had higher inflation before, that was back in the 1980s, right? And some of us experienced that. Some of us have mortgages back then. Many of us didn't. We don't even understand what we're going into because we've never lived through that kind of an environment. But we averaged about 5% on inflation during that decade. Even though there were periods when it was double digits, got up to 11 or 12, the whole decade averaged about 5. So what did investors do? Investors had about a 13% return on bonds, and they averaged about 17.6% on stocks. Not all stocks are created equal. Some perform poorly. And I would say cyclical companies, anything that's very sensitive to interest rates, utilities might have a tough time right here. Real estate companies are typically sensitive to interest rates. But consumer staples, commodities, raw materials, those kind of companies did really well, even better than this on an average basis through that decade. And that's why we've been talking in the last several months about commodity exposure, raw materials, reining back in some of these discretionary companies, like some of the tech, some of the things that we really don't have to have. That's the first thing that's going to get cut out of our budget as consumers. So we're talking about portfolio shifts now, getting a little bit into the details, but know that there's always some strategy around it. One thing I want you to remember is we're not trying to time things here in our office. And I would advocate for you as an investor, hopefully you're an investor, that that's not the best overall strategy, is trying to jump in or jump out. I hear that all the time. And I've been doing this for 25, 26 years now. And the folks that are over here in this camp, the traders, or the speculators, I'll call them, they think they need to do something all the time. And so think of it as a business owner. And a lot of you are watching this are business owners. Imagine you deciding, because you heard somebody on TV say that we had an inverted yield curve and a recession's coming. Should you sell your business? Would you seriously think about selling it just based on that? Dumping it all for whatever price you could get? because that's essentially what you'd be doing if you decide to sell all your stocks because you're worried about where the market's going, where the economy is going. What you've got to remember is you're a long-term investor. You're a business owner. And I think people forget that because when they buy stocks, they're thinking, I just have chips. I have chips that I need to take off the table. I have nothing. But what you have is ownership in a business. Remember that. It's so important to navigate some of these unprecedented times, these volatile times, as volatility is picking up. We need to keep our senses about us. I'm going to stop here. Shaun's going to talk a little bit about our strategy for you and how we get through some of these environments.
So as financial advisors, we are often dealing with money in motion, and that could be from somebody retiring, somebody maybe sold a home, or they sold a business, or they're getting a divorce, and there's cash in motion, there's a lump sum. And folks right now are really nervous, and they're maybe not sure what to do. Markets are maybe a little bit choppy, or there's a war in Ukraine, or there's inflation running through the roof, so people are like, what do I do? So that kind of forces people to think, I'm just going to wait. I'm going to park this in the bank, or I'm going to park it in cash, and that can be very costly. So our approach to that is a little bit different. We look at that and we say, all right, if I'm receiving a lump sum for a client, whether, like I said, retirement, cash from a sale of a business, whatever it might be, our policy is we put 50% of that to work immediately when it hits the account in the models, in the strategy that we've already assessed and made sure makes sense according to their financial plan and to their risk tolerance. So 50% goes to work, and we're going, all right, great. If the market goes up, we're participating in the increase in value. But think about that. If you put 50% in, would you rather the market go down for the next 50% or go up? So it's comforting knowing, yes, I'm making money, but now we're going to put that next 50% in, and our policy is within 2 months. So we could be buying at a higher price, but ideally we would want the market to get worse, right, and buy at a lower price, which is very difficult for the individual investor to do because it's so emotional. It's like this is that lump sum that they've got, right? Now, over the long period of time, I'll just tell you, the studies will show it doesn't really make a difference that much. Because if you're talking about, investing dollars today, and now we've got a 20, 30, 35-year retirement, it won't matter. But it just kind of feels good to time that market right. We're not market timers. We don't want to be market timers because there's a lot of risk to that. And I want to talk about why. So if I took a look at the S&P 500 over the last 20 years, and let's say we put money in, and I've got some numbers here that I'm going to use, but just for easy numbers, if I put $10,000 into the S&P 500, your total return is your $10,000 would grow to just shy of $62,000, and that's an average rate of return of 9.5%. Now, if I missed the 10 best days, this is 10 days, okay, in a 20-year period, guess what your return would be? 5.33% was your average return, and that grew to $28,000. That's a big difference. Staying invested, $62,000, missing the 10 best days, $28,000. What if I miss 20? I'm just going to go 20 days here. 20 of the best days. Your return drops all the way to 2.63% a year, and your 10,000 grew to 17,000. This is the risk we're talking about. And when do the best days usually occur? It's usually right after the worst days. So if you go back to March of 2020, so March 12th, that was the second worst day. And that was followed, the immediate next day was the best day in the market. So you're missing that return by trying to time the market. And that's why we're always saying, hey, we're not market timers. We don't want to be. It's impossible to do. We're building diversified portfolios, and then we're making adjustments around that. So if we see, inflation's very high, well, what asset classes perform well in inflation? I think Billy talked about this earlier. Commodities typically do very well. So maybe we carve a piece of our portfolio out to add to that. We're never trying to go in, out, and this is the reason why right here. So we have a plan for clients that are in distribution mode. We've already built up some cash positions. Or if we're going through a down equity market, we're looking at some fixed income positions to get that monthly income out to them. People with new money, I I look at this as a very exciting time. I'm going, oh wow, the market's in a correction. I have an opportunity. Here's value. It's like if you're looking at a home, right, on realtor.com or whatever, and you're serious about buying that home and it's been at 500,000, all of a sudden the buyer lowers the price to 450. Are you going, hey, that thing's on sale? For homes, most people or clothes, they think, yeah, it's just on sale. With the market, it's funny how people think, oh, there's something wrong. There's something I don't know. That's not the case. It's just people selling for whatever reason, for panic or fear. And I look at that as a very good opportunity. So that's kind of our approach with investing. We're always here to answer your questions about your own specific situation that you've got going on. Please feel free to give the office a call. Thank you.